Good morning, everybody, and welcome to our Wednesday morning training at GoPro Trading Academy. It's yours truly, Ian Giffen here, and we are going to be discussing today the subject of strategy selection as requested by you guys, our members in the Academy. And it's quite an interesting topic, but before I jump into the details, I'd like to first of all set the stage for the discussion by showing you that you probably have a completely wrong idea about what you need to be thinking about when selecting your strategy or strategies in your Forex trading or trading generally for that matter. The result of your predictive mindset, as always, means that you are first and foremost going to be thinking about finding a strategy that will make you money. And of course, you should be thinking about being profitable in your trading. Obviously, this is all about making money. But just because trading is about making money doesn't mean that it is the first thing you should be thinking about when it comes to selecting your strategies. Now, I know that sounds a little bit counterintuitive, but it remains true. So bear with me while we go through this and you will understand exactly what I mean. First of all, let's talk about one of the really common myths that most people are told they need to be thinking about when selecting a strategy. How many of you have been told that you need to select a strategy that conforms with your personality somehow, or that your trading style needs to fit with you in some way, and that this is a natural thing that you should be thinking about? I've certainly heard a lot of people say that they've been told that. In my exposure to a few training institutions, normally for amateur traders, it has to be said, it's not an uncommon message given to people who are being taught by various coaches and various training schools. But it is completely incorrect, because at the end of the day, one thing I can promise you is that when it comes to trading, we all basically want the same thing. Our personalities, when it comes to this topic, are effectively all the same. How is that? Well, the natural instinct of the human brain, being a predictive engine, is to try and avoid unfavorable outcomes and to engineer or even try to guarantee favorable outcomes. It's the way we are. Now, if you want to talk about the personality of, well, your personality, it's the same as mine and everyone else on this call and anyone else listening to this recording. We all want exactly the same thing. We want to win every trade and we want to avoid losers. It is the way we are made. Every decision that we make in life is based on the fact that the human brain is designed to avoid unfavorable outcomes and to try and create or ensure favorable outcomes. It's part of what uh, makes us successful as a species. It's part of our survival mechanism, and certainly it has worked very well in terms of our ability to control our environment, firstly, and also to identify naturally recurring patterns in our environment so we can take advantage of those with the objective of avoiding negative outcomes and ensuring positive ones. Now, unfortunately, as you guys who are on my training, and certainly those of you who are in the academy already know, when it comes to trading, neither of those two things exist. We cannot control the environment when it comes to the markets and our looking at our charts and our trading environment, firstly. And secondly, the search for the holy grail of a reliable, naturally repeating patterns in the market is obviously a lost cause. Now, that doesn't stop you from trying. I'm sure many of you, and certainly if you haven't been in the GoPro Trading Academy for long, will still be grappling with this challenge that you are trying all the time to find a naturally recurring pattern in the markets that you can use to avoid losing trades and to guarantee winning trades. Tell me that I'm wrong. Examine yourself, understand who you are. You need to understand yourself clearly in order to be able to overcome this obstacle. So in order to be able to make really good progress and for us to be able to carry on with this discussion about how to select a strategy properly, you need to understand that this whole thing about finding a strategy that fits with your personality is a myth, because it actually has nothing to do with you. Trading success comes from something else entirely. And as you guys should know by now, it is all about finding a way to dominate what is an absolute reality in our trading environment. And that is the reality that the market is completely uncertain. In fact, for all intents and purposes, that our trading environment is effectively random. This is embodied in Mark Douglas's statement in his 5 fundamental principles or truths in his book Trading in the Zone, where he says anything can happen. That's the first of his 5 fundamental principles. Anything can happen. Now, that is true. It is certainly very true in the markets. And not only is it true in the markets, it is visibly obvious all the time from moment to moment. If you trade the lower time frames and you sit in front of your charts watching those candles or bars going up and down and looking for some way to identify what's going to happen next, by now you should, even if it's only in the back of your mind, be aware or have a sneaking suspicion at the very least that there's no way of knowing what's actually going to happen next, not at a meaningful level. It is true that one of our cognitive biases allows us to filter out those times where we fail to see what's going to happen next. Uh, Unfortunately, that is true. But if you are aware of that, then you will be honest with yourself about not only finding those moments where, yes, you did see price bounce off of a support or resistance level. You will also see the times where your expectations were not met. Our selection bias tends to filter out those times where we were not successful and to retain those where we were successful. Backtesting has the same problem. But if you are trading already and you're actually applying a strategy, then the bare-faced honesty of the fact that we cannot know meaningfully what is going to happen next becomes obvious to you. So our goal as traders is first and foremost to dominate uncertainty. How do we do that? Well, the second of Mark Douglas's statements is that you don't, in fact, need to know what is going to happen next in order to be profitable. Now, most people gloss over these statements at an intellectual level and tend to agree with them without thinking about them or internalizing or even meditating on these concepts. Because as soon as you do that, you will realize that there's a fundamental or an apparent paradox between these two statements, that the market is basically random, but hey, guess what? You don't actually need to worry about that. You don't need to be able to know what's going to happen next in order to be profitable. Because given the fact that you have this thing called a human brain, which is a predictive engine, you're immediately going to resist that. In fact, it's going to seem like a paradox to you. How on earth is it possible to have a positive expectancy over time? How can you be profitable? How can you make money in trading if you don't know what's going to happen next? It sounds like complete nonsense. It sounds like a crazy principle. But in actual fact, it's not. The reason why it seems that is simply because of the nature of our thinking, the way our brains work. The answer is actually out there. It's out there for us in the universe. It's out there in how everything else outside of the way we think actually works. And it's a very interesting topic. And if you haven't yet got my book, The Consistent Trader, I recommend that you get a copy of from us. You can just drop into the comments below book, and we will connect with you to send you a free copy of it. But in my book, I elaborate on these concepts quite a lot more substantially because they have real practical implications for us as traders. Now, it's not about the theory behind these things. We are practitioners at the end of the day, and our goal is to be able to turn a profit by dominating uncertainty, by conforming to a set of principles that allows us to do that. Well, in order to do that, we need to conform to the 3 pillars of dominating uncertainty. So again, those of you who are in the academy and have done my training before will be very familiar with this. Let me just go up a little bit here. In this diagram, we have the bedrock of reality, which is that we are dealing with fundamental uncertainty. The fact that you need to embrace that first is a prerequisite in order to be a trader. But then on top of that bedrock of reality, you need to put in place the three foundational pillars that will allow you to not only survive as a trader, but to thrive. And not only to be profitable in the short term, but to keep your money and continue to make profits and create wealth over the long term, unlike the majority of people who even become profitable in trading. Now, those three pillars we've discussed many times in the past. I'm not going to belabor the point that you need to have an edge. It needs to be a convex edge, and we work that edge using the law of large numbers. They're not difficult concepts, of course, but in order to apply them at a practical level, that's where the difficulty starts creeping in. Most people don't understand the implications of that, and we will talk about that in a second. But coming back to what makes a good strategy, therefore, we need to have that edge. We need to have an edge overall at an account level. That is what we call convex, which is quite simply being an approach to the market that seeks to, first of all, limit downside and only then looks to maximize upside, which means that risk management comes first. And of course, most people pay that lip service. Very seldom do they apply it at a practical level, however. But if you do, and certainly using the concepts that we teach you and even the strategies and the training that we give you in the academy, if you do apply all of that at a practical level, then certainly you will be conforming to those three pillars. And that is an absolute prerequisite in order for you to select your strategies. You need to take these principles into account first and foremost when selecting your strategies. And the reason for that is everything else that we have here, including the strategy elements being, we'll come back to that in a second, but selection, timing, and management, these are all built on top of these foundational pillars. They all need to apply the principles of our foundational pillars. We can't exclude those foundational pillars and the principles that they embody from any element in our approach to the markets, least of all our selection of strategies. All right, so at a conceptual level, we need to have at least one strategy that conforms to the three pillars, and certainly our overall account level needs to conform to those. Now, that includes particularly pillar number 3, which is convexity, seeking to limit downside first and foremost, and only then looking to maximize upside. Again, that doesn't necessarily come naturally to us, because especially when you're starting out as a trader, your natural instinct is to grasp a strategy that first and foremost you believe, well, that makes you money, that is profitable. But secondly, and very importantly, a strategy that makes you feel good about your trading. And again, coming back to what we said in terms of the common myth, we all want the same thing when it comes to that, which is avoidance of losing trades and trying to guarantee always that the next trade will be a winner. That is, in fact, the road to destruction. It may be counterintuitive, but history is very clear on that, both in terms of amateur and retail traders, but even at the institutional level, where we've seen so many big funds come crashing down because they failed to apply this principle of convexity. So that's the first thing that we need to ensure, certainly when it comes to our the first strategy that we're going to be looking to select. It must apply the principle of convexity. And that would be what we call a core strategy. So the first strategy that you should look to try and trade would be a core strategy, or at least a variation of a core strategy. And of course, those of you in the academy who have learned the daily impulse know that that is a core strategy. The starting point is, in fact, a variation of the daily impulse, where we use a hard target or a short target. The complete version of the daily impulse is where we use a potentially unlimited upside, where we don't, in fact, have a take profit level at all. and we use trade management techniques to get us out of the trade. But in doing that, what we're doing is applying the principle of not only limited downside, but potentially unlimited upside, which of course is the extreme of convexity. Okay, so that's the first thing that we need to have. Now, as I point out, account level convexity doesn't necessarily mean that we're only going to have one strategy, first of all. In fact, most funds, most accomplished and successful money managers and professional traders apply more than one strategy. And the reason for that is to try and improve the convexity at an account level instead of just at a single strategy level. So although core strategies certainly do come first, we need to also realize that we need something else, which is what we call an overlay strategy. Now, an overlay strategy, the purpose of an overlay strategy, although in principle it might seem easier to trade, is not in fact about profitability. And again, when I talk to folks about this on my training courses, and they look confused when I introduce the concept of a strategy that is not designed to be profitable, I mean, right now, ask yourself, why on earth would you trade a strategy that you know is not profitable? And most people would say, well, I wouldn't. That just doesn't make sense. Well, if that is your answer, then you are proving that risk management does not come first in your trading approach, and that profitability is your primary, if not your only concern. So ask yourself that question honestly. If when I asked you the question just now, would you ever trade a strategy that is not necessarily profitable? And your response would be, well, no, that would be crazy. Then you need to recognize inside of yourself that that predictive mindset and that need to generate a profit above all other things is still very strong inside of your mindset, and that you haven't yet sufficiently developed a robust trader's mindset. A mature trader understands clearly that trading some strategies that may not be profitable in the long term is an absolutely good thing if it allows us to reduce risk over at an account level, at an overall account level. And that is all that overlay strategies are in fact meant to do. So when it comes to choosing strategies, we should at least consider in the longer term that we need to, first of all, have a core strategy. Yes, we do. But we also need to learn how to apply and why we should apply an overlay strategy. Now, the one thing about core strategies, as I've mentioned over here as well, is that they are difficult to trade. And that is why we very often introduce these strategies uh, at some sort of level of variation. And as I mentioned just now, having a fixed target where we would use, for instance, one of our variations is to use the high time frame ATR as a target, uh, allows the novice trader to get into the swing of things, to learn how to trade a convex strategy, but one where the challenge to the mindset is less extreme than trading a fully convex strategy. And why do I say that? Well, it's because in order to trade a convex strategy, you need to accept a relatively high proportion of losers. Why do I say that? Well, what we're applying here is the principle of cutting losers and letting winners run. And in fact, that is probably one of the oldest sayings in trading in the markets. Cut your losers, let your winners run. I'm sure everybody here has heard that before, either from me or if you're new to the academy, I'm certain you've heard that somewhere else. Well, all that represents, again, is the principle of convexity, cutting your losers and letting your winners run. Everybody pays lip service to that again and agrees that that sounds sensible. But very, very few people ever learn to apply it at a practical level. And the reason is that within that statement, what is hidden in that statement is the fact that if you do that, if you do cut your losers and let your winners run, or if you apply a strategy which is designed to cut losers and let the winners run, you will guaranteed have a higher proportion of losers than winners. However, the size of those losers will be relatively small whereas the size of the winners will be much bigger. And of course, that is what limiting downside and maximizing upside is all about, which is what convexity is all about. But it is very difficult for most traders to actually do that at a practical level. We are designed to try and avoid losers, especially when it comes to our money. Losing money is a naturally painful experience. I'm sure you would agree. And we are at the very fiber of our beings, at that level, we are designed to avoid those experiences and to seek to guarantee winners. That is the way we are. And that is what makes this so difficult, because convex strategies tend to have lots of losers. I mean, I'm not going to get into all of the details behind the psychology of this, but the fact of the matter is a small loser is at a psychological level has the same negative impact as a big winner has a positive impact. So we end up with a psychological deficit if we have a higher proportion of losers. And dealing with that is what developing a robust trader's mindset is all about. Now, when you start off, you don't have that. I can guarantee you. I have taught hundreds and hundreds of people how to trade over the last decade. And I can tell you one thing for sure is that anybody who has come to me initially believing that they've already got a robust trader's mindset, I've proved to them that they're wrong. I've proved to people as well that even after several years of trading, you will still be looking to develop your trader's mindset, because we are all human. So you need to understand that although this is the right way to do things, it's not easy, especially in the beginning. And to be honest with you, after a career in trading of over 30 years in total, I am still working on my trader's mindset today. So never ever think that that journey is over. All right, so, but it doesn't detract from the fact that there are the most difficult types of strategies for beginners to trade, not because they're technically difficult, quite the contrary, in fact, but because of the mindset challenges. All right, so the final kind of strategy that we will look to apply over time, given the fact that we need to start off with core strategies. Secondly, we look to apply overlay strategies to increase the account level convexity. And finally, the third leg strategies, not necessary, I would say, but potentially good to have, are strategies which would be more neutral, if you like. They are profitable, but they're more bread and butter type strategies. They tick over generally at a relatively slow level, and they fall somewhere between overlay strategies and core strategies. They're not entirely necessary, but they can be good to have. All right, so there's a lot more that we could discuss about these issues, but this being an introductory discussion, let's move on then to some of the practical considerations when it comes to choosing our strategies. First of all, as I've already mentioned, your strategy must define all three of the elements that make up a good strategy. So what are those? Well, first of all, you need to have all selection criteria fully defined. In other words, you need to be able to define very clearly what the appropriate conditions are for that strategy, so that you can apply your skill set to answering those selection questions before looking to take a trade or place an order. Just as importantly, that means that you know when not to trade. Secondly, timing is the rule around when you enter and when you exit the market. So timing includes obviously the entry, the initial stop, and the take profit, if you have one. And finally, you need to have all of your trade management rules clearly defined. So the first of those trade management rules is obviously money management, which is a different topic in itself. We covered that in a recent training session. So please go back and look at that recording if you haven't watched it. Secondly, you need to know what you're going to do with any orders that don't trigger within the required time period, and you need to define what that time period is. And that's assuming, of course, that your strategy requires you to place pending orders. Not all of them do. And finally, the third management element is whether you manage the stops and take profits over time whilst the trade is running. The trailing stop methodologies that we teach being clear examples of that. So your rule set must be absolutely crystal clear on all of these elements. There should be no discretion involved at all. Discretionary trading is not something that long-term successful traders do. Once again, history is absolutely clear on that. Systematic trading long-term is the only way to go. So if you have some discretion in your rule set, in your approach to your trading, it means that you haven't yet clearly defined the rules for your strategy, which means you don't actually yet have a complete strategy. There is always a better way to do something. And the only way to find out what the better way is to test, 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 test. And once you've done that, you can make a determination as to what the right thing is regarding any question relating to your strategy. And that includes all of those elements: selection, timing, and management. So obviously we look to teach you guys strategies that obviously have been well tested over a long period of time. But you'll also notice that over time, we're given new information as to the performance of these strategies, and we adjust and amend them. And of course, you can see all of that taking place in the academy over time. But just to reiterate, you have to have all of these nailed down completely. I would say, in fact, that the final decision, discretionary decision that you need to make, is the selection of the strategy itself. Once you've made that decision, then everything else should be mechanical, absolutely mechanical. All right, so that's the first thing. You must have all three elements of the strategy very clearly defined. Secondly, however, there's no point in you looking to trade the 5-minute chart if you've got a day job. Likewise, the H4 strategies can be quite challenging because you need to look at the charts every 4 hours. So for many people, the reality in their trading is that you are an end of day trader, where you literally only need to look at your charts once a day and complete all of those elements: selection, timing, and management at a certain time of day. And there's a lot of additional value in that, because it also teaches you the discipline of not touching your trades for the majority of the time that they're actually running. And when you do actually do anything to them, it is in conformity to your rules, and you don't do anything outside of that. Right, so that's obviously an important one and a practical one. Thirdly, I should say, technology available as well. So when you look at some of the big funds and the hedge funds or absolute return funds that trade in a similar way to what we look to do, they have computer programs that actually run the majority of their trading. Obviously, inside the academy, we're going to be launching our trade management software for the strategies that we teach in the near future. So that is an example. For instance, the H4 Impulse, you guys who are trading it know it is very time intensive and it can be pretty tiring to need to keep looking at your trades every 4 hours. In fact, it's generally physically impossible. And not being able to do that does have an impact on the performance of the strategy. So that is obviously another clear practical issue that needs to be taken into account when choosing a strategy. And as I've mentioned already, mindset and level of skill set as well. So if you are not used to trading a strategy where you really don't know what's going to happen in the next 1, 2, 5, 10 trades, and you understand that you don't know, and you've gotten over yourself in accepting that you don't know, well, if you haven't got to that point yet, then you definitely don't have a robust or professional trader's mindset. The professionals take every single trade. For those of you who've been on my training in the past, you will remember me referring to a discussion between Jack Schwager, who wrote the books Market Wizards and New Market Wizards. One of his interviews was with one of the most successful traders, probably of all time, certainly of modern times. And his name is Ed Seykota, and he's a private trader. He obviously trades money for clients, but Nobody knows how much money he's got or assets he's got under management, and he's a very secretive trader. But one thing we do know is that he is also very much a trader who focuses on convexity. In any case, when he was questioned by Jack Schwager in an interview for his book, one of the questions he asked him is, what is it that separates the professional trader from the amateur? And I'm sure you'd agree with me, that's a really, really good question. Now, he could have said many things. He could have said that the professional has got better technology, or that he's got better strategies, or his ability to read charts is better, his skill set is greater, and various things that many of us would have said. Well, he didn't say any of those things. All he said was the difference between a true professional and everyone else, basically, is that the pro always takes the next trade. That's it. That's all he said. Now, why would he have said that? Because first of all, there could have been any of those other things, but why would that even be important? What is it that should make that important? I mean, surely a professional trader who knows how to read charts well, who's got great strategies, well tested, who's been profitable for years, why would that be an issue? Because most people picture really successful traders as traders who don't really lose very often. Well, if you don't lose very often, you would have no problem taking the next trade, would you? It would not be a challenge. It would certainly not be something that differentiates the professional from everybody else. The reason is because of convexity. The reason is because professionals always trade convex strategies. And one of the defining elements of convex strategies is that most of the trades lose, which means it can become very difficult to keep taking the next trade. It's easy to take the next trade if you've just had a string of 5 winners. If most of your trades are winning, you will have no problem taking the next trade, whether you be an amateur or a professional. The reason why that is the single most important differentiator of the professional trader is because they are trading strategies where most of their trades lose. But they know that, and they've accepted it, and they've developed their mindset. They've developed this professional, robust trader's mindset that can deal with that. They've disempowered their expectations of what's going to happen in the next trade. In fact, as I teach you guys in the academy, with a true core strategy, we actually expect the next trade to lose. And that in itself is very powerful, because if you expect the next trade to lose, you're not disappointed because your expectations are met. You're only disappointed and have psychological and therefore emotional challenges when your expectations are not met, which of course is something we also discuss in a lot more detail in the training and in my book. But it comes down to that, folks. It absolutely comes down to that. If you don't yet have a really robust trader's mindset, then you're not ready to trade a truly convex strategy. But having said that, you guys can see that I introduce even our new beginner traders. I don't introduce them to strategies with a high success rate. I could, but I don't. And the reason is, in order to become successful as a strategy, I don't need to teach you a profitable strategy. There's loads of those out there. I need to teach you first and foremost how to think like a trader. And strategy selection comes down to this. I need to help you guys to choose your first strategy, not because it's profitable alone, which they are, but because they will help fast track your development as a professional trader. That's why in GoPro Trading Academy, we start with a strategy like the daily impulse. And we don't start off with a variation on any of our strategies where you have a much higher success rate and a high proportion of winners. I introduce you guys right up front to the concept of being able to trade a strategy where you really don't know what is going to happen in the next trade or even the next 5 trades. Because that is how we fast track you in developing you as a professional trader. And folks, that is how you select strategies. That's what you need to think about. So practical considerations include, why do we start with a relatively convex strategy up front? But obviously, today we've delved into a few other aspects as well, including why we would choose a strategy that isn't in fact profitable overall. It is profitable when our core strategies, or tends to be profitable when our core strategies are losing, but it makes money as a rule. I beg your pardon. It loses money as a rule when our core strategies are making money. And that makes sense if you think about it, because overall the account level profitability tends to remain about the same, but your maximum drawdown is less, which means you're making the same level of profits for lower risk. And that's the name of a game when it comes to professional money management and trading. Right. Any questions? I see we've got a few. Making money is absolutely easier than keeping money. I think Nassim Taleb in his book says putting on a profitable trade is actually easier than frying an egg. And if you haven't read Fooled by Randomness, do yourself a favor and get that book. Another of the foremost and most influential traders of modern times is Nassim Nicholas Taleb. And the first book he wrote back in 2003, I think it was published, or maybe a little bit before that, was called Fooled by Randomness. And in the title, I'm sure you'd agree, is it gives away the challenge that we have as traders. Yes, it is easier to make money in the short term. It's not, in fact, that difficult. I keep telling you guys now, training as well, is that although only about 20 out of 100 people who try trading will learn to make money, of those 20, only 1 or 2 will survive long term. Unfortunately, the other 18 or 19, even though they learn to be profitable in the short term, will blow it in the long term. And the number one reason for that, in fact, is that they have chosen strategies that are not convex. So it's a very pertinent point. Thank you. When it says I was one of the confused ones with the overlay, but I understand now, that's great. Thank you. Yes, it's normal, to not immediately grasp why one would possibly want to trade a strategy that's not profitable overall. Excellent. Dion says, does taking the next trade refer to taking the next trade on the same currency pair you just lost on? Dion, it includes that. It is taking the next valid trade according to your strategy across all of the instruments that you are trading according to your trade plan. So if you've just had a losing trade and you get another setup, yes, you take that too. H4 trading can be like bot auto trading. Well, it's not entirely auto trading with the software. It's trade management software. You still need to decide on whether the conditions are appropriate for the strategies or not. But it tends to take care of the trade, or it does take care of the trade management for you, so that you don't need to look at the chart every 4 hours. But the primary responsibility is still with the trader when it comes to selection. And of course, out of those 3 elements that you need to clearly define in your strategy, selection is in fact the toughest one. Timing and management are, once you've learned how to trade these strategies, they are very, very mechanical, which is why it's relatively easy to automate them. But the selection is the big one. That's the big one, and that is still up to the trader to do. Pino says, so practically when looking at the charts for potential setups, one would look firstly for core strategy setup, then overlay, then third leg. So then go with whatever the markets present to us. Okay, so it's not about the time, it's not about the sequence in time or the chronology of it. So you don't need to worry about what comes first. You actually trade the strategies separately, but in terms of the way the strategies are designed, they do kind of fit together. So you don't need to say, oh, I've just had a core trade, so I must now take an overlay. No, not at all. You apply them separately. You think about them separately, but at the account level, they tend to, well, the job that you're trying to achieve, certainly with the overlay, gets done. Sinji, we don't have a third leg strategy published inside of the GoPro Trading Academy as yet. Many of you are familiar with a short kickstart that we taught in the past. That will be published in the future as one of our strategies. Many of you have done that with me already in the past. That would typically be a third leg. Dina says, did you not say that if you are stopped out of a pair, wait for the following week for a new setup? Dina, you're referring to the daily impulse. As a rule, that's precisely what would happen generally with the daily impulse. So that is, let me put it this way, the chance of you getting another setup immediately after being stopped out on a daily impulse in the same week is very, very low. Hopefully that clarifies that. Any other questions, folks? You're welcome. All right, perfect. So folks, if you're not familiar with many of these concepts that we're covering over here, please be aware that we have lots of this training, previous training done inside of our Facebook group. Also, please jump into the Facebook group and introduce yourself. And tell us about where you're at in your trading, what experiences you've had to date, where you feel you are in your trading journey. Certainly help us to see how we can help you if we can get to know you a little bit better. So please don't hesitate to do that. Also, we've got our YouTube channel. If you've got any questions, please drop them into the comments, either in the Facebook post or in the YouTube channel. All right, so if there's any other topics that we need to cover, please just drop those questions into the Facebook group as well, and we'll answer them there. All right. Okay, folks, so once again, I look forward to doing more of this training with you. This topic was in response to your requests inside of the Facebook group. The poll is still up there. Please add your vote as to what you would like me to do training on each Wednesday. It is obviously something that we're committed to doing on a regular basis, and I look forward to helping you guys with that. So again, drop your comments and questions into either the group or into the channel, and we'll chat about it then. All right, folks, have a great week further, and I'll chat to you soon. And for those of you members, remember tomorrow we have also got our members training where we're going to be delving into the definition of some of the channels. Right, have a great week, guys. Chat soon. Bye for now.